Hey guys, just want to do a quick update on what's happening with the market. So today the RBA decided to increase the rate again to 4.1%, as you can see, just to get our inflation down, which sits at 7%, which they think is still too high at the moment. So what's causing that? The main factor, apart from inflation, the Labour government obviously decided to increase the minimum wage for certain sector to 5.3%, and that played a part in the interest rate as well. As you know, increased wages equals increased spending and increase inflation. So the sad reality is that, in my opinion, people need to lose their job. We need to keep the inflation, keep the unemployment rate up to about 5% or more, and then the inflation will come down, which I don't think is going to happen anytime soon. So let's have a look at what's really happening in the market. As RBA, we all know they're trying to get the inflation down to about the 2 to 3% target range, which is they're aiming at. So, in terms of long term, are we going to have another inflation or what's going on? Let's have a look at the AX 30-day cash rate. Keep in mind that was done before the rate increase. So where we sit at the moment, we're sitting at 4.1%. According to this chart and the prediction, we're probably going to hit somewhere close to the 4.5%, possibly, depending on how the inflation result goes the next few months, and also our employment stats. So if our inflation rates are still high, unemployment stats are below 4%, there could be a chance another rate increase. So we need to watch this carefully. But where we see at the moment, if we're at 4.1, the indication, let's say we have another increase somewhere here. Up to December, we'll probably have a holding pattern with the rates, possibly one drop. And then going forward with the rates, what we're looking at will be November 2024, we'll be hitting around somewhere close to 3.5 mark. So what that means as a property borrower, you're probably looking around a 5 to 6%. I would say 5 to 5.5% as a reasonable rate going forward until November 2024. So the other thing we'll need to have a look at it as our RBA follow closely with the UK does. Let's have a look at the UK market as to what they're doing with their inflations at the moment. Let me find the inflation chart. Wherever it is, market and the money. Markets. GDP. There's inflation. There's inflation rate. So this is what's happening in the UK at the moment. So as you can see there, inflation rates are going up all the way to October, and it had a steady drop to 8.7 in April. And there, rates, what we'll be looking at, interest rates, is going up and up because the inflations are too high. So currently where they're sitting, according to latest data, they're probably sitting around somewhere around the 4.5% mark. So obviously RBA, they'll be looking closely what's happening with the UK market, and they probably follow their similar monetary policy, being a Commonwealth government. So need to look closely with that. The other one we can look at is probably the US, what they're doing with their market at the moment, with their inflation rate at the moment. Those the indicators, where are they? So their inflation rate is currently sitting around the 5% mark, and their rate's around the 5%. So I'll come back to it later if I do find it. So let's go back to our market analysis, the main factors, and see where we're sitting at. I don't think it's changed much since last time, unless the data is being updated. Unemployment rate, where are we sitting at the moment? So that data hasn't been updated April, so we're still sitting around the 3.7 mark. So it depends on how that unemployment rate goes, and that will have an impact on the RBA decision with the rate increase. So if that unemployment rate shoots up through to 4 or 5%, they will have a reconsideration on what's happening with the market. In terms of whether they're going to rise another interest rate or not. Our inflation rate again sitting around the 7%. That hasn't been updated, so we know by end of June where this sits at. Interest rate, we know we are creeping upwards, so we're sitting at about 4.1 at the moment. So there's not too much changes. Building permits, so they updated that. Oh, hasn't updated. So again, we're looking at decline. So that's linked to housing shortage at the moment. So we need to get this building permit level all the way up to somewhere around here, at least 18,000 to have an impact on the houses. Home loans. So that's the April data at the moment. So where are we sitting? So it's sitting somewhere around here. Had a drop. So we'll know probably next few months as to what's happening with the home loan rate at the moment, the amount of home ownership. Investment lending. So April is very similar. It's down a bit. So we just need to watch closely. There is probably a lag of 2 months and we know what's happening in the market. So with the latest rate increase, it's yet to come into effect with this. So we'll find that out shortly, next few months. So this is pretty much all the stats. Now, the next thing I want to go to quickly would be the Mate Housing Index. So if we have a look at it, this is the latest as of May, the quarterly changes of the housing prices. As you can see, New South Wales performed strongly. Victoria houses, the capital's gone up, regional's gone down. Queensland had a steady increase, same with South Australia, WA, Tasmania's kind of gone down. Northern Territory's gone down and Canberra's gone down a little bit as well. So this is yet to take effect, the latest interest rate. So it'll be interesting to see what's happening here in terms of where we're heading with the market. The other thing we need to look at migration forecast, where we're sitting at the moment. So with the property prices, at the moment, the biggest problem we have is probably housing shortage. The housing crisis is not going to go away any soon. As you can see with the migration stats, we're still playing house catch up at the moment since the COVID time, where we're having this massive boom, 400,000. So gradually, that will go back to a steady of 260,000, but that's going to be 2024 onwards. So what that means, with all the inflow migrants, we need to put them somewhere. And unfortunately, that's going to create more housing shortage. As I said, for the housing prices to dip, you need to look at demand and supply. At the moment, there's not too much supply on the market, and that's what's driving the housing prices up. There are a few factors obviously leading to that. Number one factor will be the construction. Construction have slowed down, and the reason for that is with the increased interest rate, the builders are very reluctant to build on it because they're paying interest, and no one's going to build on a high interest with low margin. So what that means is there's going to be less build. It's going to further increase the rental crisis, and there's just not enough supply at the moment to keep up with the demand. So therefore, the housing prices will keep on going up and up. Now, the other thing is the flow-on effect. With all the migrants come in, because there's not enough houses, the rents are going to keep on going up and up. As the result of that, it's going to lead to more housing shortages because all the renters are going to look at purchasing properties because they've been squeezed out of the rental market and they're thinking about purchasing their own. So that's going to drive up the housing prices further. So we're definitely not going to see a decline in house prices because of those factors. Now, the other thing is with those migration forecasts, there's probably going to be a lot of foreigners coming that are cashed up, looking to purchasing properties. And again, that's going to put a strain on our housing market. So if you're looking at all those factors, there's no way that our house prices is going to drop any further. There might get to that stage where we have a steady housing price. It won't increase as much. However, we're definitely not going to see a decline of the housing market. Let me share another chart with you and explain the reason. This is the property house cycle since the 1970s. So we have gone through inflation rate, cash rate, GSEs, mortgage stress, and so on. So as you can see, since the 1970s, the house prices have gone up and up. It has had a few dips along the way, but it still kept on going upwards. So there's no way of housing prices to drop 20, 30, or even 40% in the current market. What I would say, in my personal opinion, you need to look at what we call the property clock, where we're sitting at the moment. So we have passed what we call the COVID boom. So that's all finished. We have passed the downturn as well. That's when we had that interest rate until last year. At the moment, where we're sitting at is somewhere around probably 6 o'clock or 5 o'clock. Some cities are probably sitting around 7 o'clock where the markets are turning back. The reason for that is due to the lack of supply, and that's what's causing prices to go up. So my guess is where the market's sitting, we can only go back up from here. And based on the previous analysis in terms of the interest rate, where the chart is sitting, so the rate's going to dip end of this year. You do want to get in the market obviously before then, before the interest rates start declining. And that's where the media will start making news that rates are dropping, prices are going to go up further, the worst is over, and then you know what happens next. Price is just going to keep on going up and up. And as the borrowing cost gets lower and lower with the interest rate, the consumer confidence will come back. So that's where I pretty much see at the moment. This is another chart talking about the 2024 market boom. So in terms of where we're going to sit, or Westpac's predicting with the market, 24, 25, they're predicting the market will drop to 2.35%. I'm not too quite sure about that. That's their prediction. In 2 years' time, we'll get back to about 2.35%. I'll say that realistically, we're probably looking at somewhere around a 3.5% next year, but only time will tell. Depends on how inflation goes over time. But according to this, we are definitely going to head towards a downward trend by end of this year. So this is pretty much my wrap up for the day. So yeah, if you have any questions, feel free to reach out to me. As I said, this is my personal opinion only, so it's general advice. If you need to rely on this information, best to speak to your accountant or financial advisor. It's no way to influence your decision at all. Any questions? Feel free to reach out to me. Thank you.